And we're back on the podcast. It's June already. Wow, can't believe it. Ernest, I was in Calgary last week, so sorry guys for the delay. We try our best to get a podcast up once a week, but life happens. We are running a business, of course. We're not in the podcast business just yet. So
Not yet.
No, not yet. So, but slowly but surely, we appreciate everybody subscribing to our podcast on Spotify and Apple and YouTube. Where our numbers are building. So thank you very much. And we're getting some great feedback. So Calgary, Ernest, booming. Lots of growth out there. The infrastructure demands are going to be just like Toronto, right? The house prices are starting to go up. So people are complaining. I don't know why they're complaining that their house price, I guess because they're worried about their children being able to buy houses. But it's a natural course of things as Toronto and Vancouver and Montreal get too expensive. New immigrants, young people looking to start families and start their lives can't afford or are priced out of the larger cities. So they move to cities like Calgary or Winnipeg or Edmonton or what have you. Hopefully there's jobs there that will make at least make them worthwhile to move there.
I saw a survey last week that said that half of residents in the Toronto region would consider moving to another city in Canada if they could work remote, just because of more affordable housing.
Oh, for sure.
And
I want my cake and I want to eat it too also, Ernest.
And the number one cited destination was Edmonton. Like, I don't know why Edmonton, but...
Okay, to each their own. I mean, if you are a person that loves the outdoors, if you love, I'm not talking about Edmonton per se, but like Alberta, there's, skiing, mountains, a different way of life that maybe and a cheaper cost of living as well. So there is, I can see why people are attracted. And we had nice meetings with clients out there. And it's very interesting to, we're always so in our lives so focused on where we live and Toronto centric or wherever you live. It's nice to get out and see the country and see how other people think and learn about their ways of lives and how they think about politics and how they think our country should be run. So I really enjoy getting out there and getting away sometimes from the flashing of the ups and downs on the stock screen. So May was a pretty good month for the markets and for our clients as well. The NASDAQ ripped up strongly. I think NVIDIA, once again, was the main driver of the stock markets in May, but overall a good month across the board. And looks like we'll see, Ernest, this week. The Bank of Canada is meeting. The potential, if not a rate cut in June, possibly in July. Do you just want to quickly talk about the Canadian, why Canada may cut rates faster than the U.S.?
Well, it's simply because of the economy. The Canadian economy is just not performing as well as the U.S. There's a chart that's circulated online that shows that real GDP per capita in Canada had pretty much followed the U.S. Up till 2015. And then since then, it's essentially flatlined.
Could part of that just be because we don't have as big a technology sector? We don't. Could it be as simple as that, where we're a little bit more commodity focused? They're more focused on technologies and chips and semiconductors. Is that a potential?
I think that's a large part of it, especially given that 2015 was the year that oil prices really cratered.
Yeah.
And that was, not surprisingly, the point when Canadian GDP flatlined, because oil is a major export of Canada.
For sure. And I see today we're talking on this week on Monday, June 3rd, that oil prices are now back down again for the year. Good news, of course, for those hoping that inflation will come down. Lots of talk. I mean, when these commodity prices rise, everybody thinks they're only just going to go up. And when they go down, they only think it's going to go one way back down again. It's pretty funny how people react online to the movements in commodities. But as the name of the podcast, Long-Term Investing, we're going to talk today about a couple companies that we believe have done great jobs in terms of capital allocation, great management. And we're going to talk, our feature discussion today is a new investment that we made for our clients. It's a stock that we have been following for about 5-6 years and finally got to a valuation where it was attractive for us to pull the trigger. So we'll talk about that. But Ernest, Costco, it seems like we talk about Costco a lot on this podcast, but it's such an amazing company. Yeah, getting quickly off tangent. I was in the U.S. this weekend for my son had another basketball tournament, and we went to Trader Joe's. We don't have any Trader Joe's. I don't think there's any Trader Joe's in Canada. No. So I had to go see it. Just an amazing, well-run store, very low prices, very busy. Looks like they do a ton of volume, and it kind of reminds me of the cult-like status that Costco has. So Costco recently reported is it Q1 earnings or Q2 earnings? Who knows? But Ernest, let's get into it.
Yeah, it certainly seems like Costco is the company that everybody loves today. There was an interview with one of the lead protesters of the boycott Loblaws movement.
Okay.
And she was clarifying that the boycott was not just for Loblaws. It was really for all of the supermarkets in Canada.
Yeah.
Except for Costco.
Why?
Because everybody loves Costco.
Yeah.
And the reason
But anybody can walk into a Loblaws or any Canadian grocery store and buy something, whereas Costco, you can't. You need a membership.
Exactly.
Yeah.
And I think that the results that we saw in the quarter really reflect the fact that everybody does love Costco.
Yeah.
And traffic was up 6% worldwide, which is crazy if you compare that to basically any other retailer.
So explain what traffic means. Is that number of people going into the store? People are shopping there more often? Is that what's happening?
Yeah. So Costco breaks down their sales into, first of all, is new warehouses, which is so obviously any new stores that they have are new sales. And then for existing stores, they break that down into traffic, which is how many times people are going in and buying things.
Yep.
And basket, which is how much people are spending every time they go in.
And both those things are going up.
No, so historically, traffic has been the bulk of the driver of Costco's comp sales because they generally like to keep prices low. And especially over the last year, prices have been going down for a lot of things. Like
so when a new store opens, generally it leads to new membership, and there's new membership all the time. So the traffic is always heading in that direction, up and to the right, so to speak.
Yeah. So essentially, people are going to Costco and shopping 6% more than they were last year, which is a very astounding result if you compare that to what other retailers are doing. I think more noticeably was their e-commerce performance, which was up 21%. And Costco's e-commerce, as a reminder, they focus on large, bulky items like fridges, dishwashers, furniture. These are things that are hard to pick up and go take home.
Totally. Generally, people will buy those bulky items at maybe a Best Buy or a specialty furniture or appliance store or Costco. And I guess if you're already a member of Costco and you're getting a great discount, and I believe Costco has a terrific white glove service for these appliances, and you trust the Costco name, you're just going to buy those things at Costco, right?
And I think that's exactly what it is, is that Costco has been adding white glove delivery service, which is the ability for them to take it in, install, and then take away the old one.
It's paying a third party to do it, but a trusted third party that you're going to get top quality. And if there's any problems, Costco will honor and make it right, I assume.
So they provide that. The prices are low, as expected. You can stack on the credit card and the 2% executive membership bonus onto that purchase. And they often throw in some other stuff like $50 Costco credit or whatever.
Yeah.
And so they're really gaining a lot of share in the appliance market. And we know that because if you compare that to someone like Best Buy, their sales were down 6% last year, whereas Costco was up 30%. So clearly doing very well in the appliance space.
I don't understand why everybody in the world isn't a Costco member, and maybe one day everybody will be.
I just bought a laundry machine from Costco.
Okay. Are you happy so far?
Yeah, it was great.
And did you? I know you are a good researcher? Did you comparison shop? What did Costco offer in terms of discounts versus, or you buying it at Best Buy or a furniture store or what have you?
So I would say Costco, the pricing for the appliance itself, the laundry machine itself, was more or less comparable to what you were paying at Home Depot or Best Buy, which is the other stores that I looked at.
Yeah.
I think what really did it for me was that Best Buy didn't do white glove delivery. You had to pay a fee for that. And Costco is probably not funded by Costco, but if you buy from Costco, you get an extra year of warranty.
Yeah.
Which is a big deal for something
That's
like
a big
fridge.
deal.
So, and of course, I get 2% off because of my executive membership. So
Incredible.
No reason not to.
No reason not to buy all your stuff going forward from Costco, and no reason for you, the listener and viewer, to become Costco members. It's a great value, clearly, and so we can see how much people love Costco in the results. Was there any interesting tidbits that you found out this quarter versus what you already didn't know?
So I think one of the things that is interesting about Costco that may not be immediately, I think is a little bit underappreciated about Costco, is that sometimes they'll call out like, oh, we sold this much of wedding rings this quarter, or we sold gold bars. That was kind of the hot topic.
Yeah.
In the last little while.
This is fascinating, and I don't think we talked about it. Is Costco is selling gold bars.
Yep.
At a discount.
Yes.
And this,
and then
it's a big driver of its e-commerce sales. Correct? You can only buy them online, right?
Yes. Okay. They called out gold bars as a big driver of their e-commerce sales this quarter, and they also called out gift cards as a driver of their sales this quarter. And I think these are kind of cute anecdotes that people share about how great Costco is. But I think what makes it really interesting is it really shows the power and trust that people have in Costco. There's no other e-com, like none of Costco's competitors, like Walmart or Amazon, right? You're not going to buy gold at Walmart. They just don't have the reputation and the trust in the name that customers have.
No.
And so
I barely want to buy anything at Walmart, but that's me.
Yeah. So, and I think this really shows to the scale that Costco has and their ability to sell products that other retailers simply can't, right? They're in the travel business, for example. They're one of the largest sellers of vacation packages.
People get their cruises at Costco. They get their contacts. They get their glasses. I mean, it's just, they make the experience, most shopping is terrible and it sucks, and you deal with shady people, and they never honor refunds or warranties or what have you. You don't have those issues when you're a Costco member. I'm sure once someone will come back at us and say I got screwed by Costco on this, that, or the other. But the bottom line is the quality scores that Costco gets are off the charts.
Yep. And so what they're doing is they're extending the value of their membership into all these other areas that you don't even necessarily associate with traditional retail. And I think their partnership with Uber this quarter, there was they announced a new partnership with Uber where you can order grocery delivery same day through the Uber app from Costco.
You don't even have to be a member, correct?
Yes.
Yeah.
And so,
but you won't get it. You won't get the 2% cash back or the discount that members will get.
Yes, and I think there were a lot of people who were kind of confused by this partnership, because if you can order through Uber, then why would you go to Costco, right? But I think the reason that this is interesting is because, again, it shows the value of. I think what Costco is doing is that if you are ordering like a pack of eggs through Uber.
You're an idiot, but go ahead. Yeah.
And you want it delivered on the same day.
Yeah.
You are not going to buy that pack of eggs from Costco otherwise.
Well, you're going to get a lot of eggs, by the way. Yeah.
Like that transaction was being taken from your local grocery store. It's mostly not cannibalizing the trip that you were going to have taken to Costco.
That's right. And part of Costco's fun is the discovery.
Yes.
Ooh, look at that. Oh, I need that. I don't think it's going to, I think you're right. I don't think it's going to cannibalize It's maybe will add increased traffic from current members.
Yes.
Can you order their hot dog and their chocolate chip cookie and
No.
from the no, you can't get food court
No
stuff.
$1.50 hot dog.
No $1.50 hot dog. Sorry.
And so, and I think you also, again, you get, I think Costco members are getting 20% off Uber One, the Uber membership. So again, another way that Costco is extending its reach into all these areas.
Fascinating. And I think Costco also called out a new menu item in the food court, the big chocolate chip cookie, Ernest. I think it has 750 calories. So I definitely am not going to have one, but it looks delicious. Have you tried the Costco cookie?
Surprisingly, I don't actually go into the food court very often. But I will give it a shot next time.
Sounds good. Maybe save half for me. So valuation. Whenever we talk about Costco, inevitably someone will say, oh my God, the stock is trading at the highest valuation ever. Aren't you worried it's going to fall in price? Aren't you worried it's overpriced? No, it's too expensive. We've argued on this podcast before that although if you look at Costco on a price earnings ratio, it on that metric alone, it does look pricey, quite pricey, but there are other factors and things to consider. Since you came up with that argument, I'll let you just talk about it quickly.
So I think this is a really good example where it shows kind of the flaws and limitations of just relying on PE ratio.
Yeah, everybody knows price. It's very easy for me to tell you what the PE of a stock is, and very easy for me to say, oh my God, that's trading at 40 times earnings. Too rich, not going to buy it. On to the next stock to look at.
Right. If life was that easy, then you go on like Yahoo Finance stock screener.
Yeah.
You search for stocks that trade at 10 times earnings. You buy those, and then you short those that trade at 30 times or higher.
Yeah.
And then be like a quick rich scheme.
Yeah, I see so many billionaires who have done that.
Yes.
Yeah. Okay.
No, not actually.
I'm kidding. That was sarcasm. Okay.
Yes.
Yeah.
Yeah. So basically, I think the story is a little more complex than that.
Mm-hmm.
I think the first thing to understand is that the PE ratio is it's a levered return. Like it measures the return to equity holders, right? It doesn't take into account. It takes into account the fact it doesn't take into account the differences in capital structure between various companies.
Yeah. So when people talk about price earnings ratio of a company, it's meaningless to quote that data point without comparing it to some other relevant competitor, peer business, something else, right? So for me, just to say, oh my God, that stock's at 10 times earnings, is cheap or expensive, is a useless statistic without comparing it to something.
Yes.
Yeah.
And Costco they have essentially no debt on their balance sheet. So most of the earnings are flowing directly to earnings. Yeah. And that typically is associated with a higher valuation.
Okay, so let's just stop right there. Break that down. So if I'm comparing Costco to, let's say, Ernest Warehouse.
Yes.
And Ernest Warehouse is levered.
Yeah.
And a lot of grocery and retailers are levered.
In more ways than one.
More ways than one, and we're going to get into that, but 3 times levered, 4 times levered, saying, well, Ernest grocery store is at 15 times earnings, Costco at 50, I'm going to buy Ernest. But if Ernest is levered at 3-1 and Costco at 0, it starts to look a lot cheaper.
Yes.
Yeah. Especially if bad things start to happen or interest rates go up or the debt's in trouble.
So Costco is under-levered in 2 ways relative to most other companies. First is with debt. They don't have, as we talked about, they don't have much debt on their balance sheet. And number 2 is that they own most of their stores. Yeah. So they don't really have to pay much leases, unlike most other retailers.
And of course, Ernest, a lot of retailers' lease obligations they don't necessarily appear as debt on the balance sheet. They're off balance sheet or maybe on balance sheet, but no one really counts them as debt.
Yep.
But they are debt. And if you want to have your store operating, you got to pay those leases.
Yep.
So it's an obligation that you have to pay or you're closing those stores. And so you have to take that into account, apples to apples, when comparing to a well-run business like Costco.
So that's the first aspect.
Got it.
I think the more important aspect about Costco is the fact that everything that they've done in their business is optimized for the long run. So as an example, right? they pay their employees very well. They pay, I think in the US, they pay $30 an hour.
It's really good.
Versus, the minimum wages, I think it's $8 or something like that. So, which is what most retailers are paying. And so you have to take into account the fact that Costco's salaries are much higher because they're playing the long game.
Yeah.
Because they want low turnover, they want satisfied employees that are taking care of their customers. And I think so that's one thing.
Yeah.
Another thing is that Costco's gross margins are lower than everybody else, right? That's why Costco is such a great deal, because their prices are lower.
Yeah.
Costco, if they wanted to, they could raise their margins a little bit. Say instead of making 15%, we're going to make like 18%.
What are Costco's gross margins compared to a Loblaws, for example?
So right now they charge about, on a consolidated basis, Costco's gross margins are 10%. So that means, basically what that means is that every dollar you spend, they make about 10 cents before paying for
Everything
wages
else.
and everything else.
Not a lot.
Yeah. But that includes things like gas, that includes groceries, which are generally lower margin.
Gas is a loss leader sometimes for Costco.
Yeah, I think they're essentially break even for gas. And then other categories like toys and those kinds of things are a little bit higher. But on average, about 10% gross margins.
That's very low.
Yes. Most retailers, like Walmart, for example, they're in the mid-20s.
Yeah.
Right? So Costco has a lot of room to improve margins if they really wanted to. And even if they raised gross margins by a little bit, like 2 or 3%, like I think it'd still be a great deal.
Yeah.
And another thing they could do, for example, is they could lower the pay for their employees.
Yeah.
They could pay them $25 instead of $30. And all these things flow directly to the bottom line of Costco. And then the multiple would look much more attractive.
A lot cheaper, yeah.
But then the business would be a less attractive business overall.
Yeah.
And so that's what Costco is doing, is that they are doing all the things that are necessary to increase the long-term opportunity of the business. And I think that's why the stock is trading at the valuation that it does.
That's right. And there's about 870 Costco stores, give or take. Most of them are in North America, Ernest. Costco said on the conference call, like, the room to open stores going forward is large, and they're going to continue to open 25 to 30 stores a year. So I don't know how many Costcos the world can support. I know there's 10,000 Walmarts. So with 870 Costco stores, there's a lot more room to add stores over the long term. One could imagine there being triple the amount of Costco stores and still not being enough going forward. So you do the math on how many years of runway and certainty there is in terms of growth with Costco. So we're pretty excited about the Costco business model. And yeah, if you want to knock the stock back down for us, we're happy to buy some more. So let's talk about our feature company. Ernest is a stock, like I said, been following for many, many years. We can talk about why we didn't pull the trigger until recently, but the company is called MSCI. And so, Ernest, why don't you talk briefly, well, we're going to talk a lot about it, but give a quick introduction about what MSCI does and why it's a perfect investment for the Baskin portfolio.
So to your point, I think a lot of times people ask me, as the head of research of Baskin, they say, you're a long-term investor, so what do you do every day? Right?
Yeah.
And I think that's a very fair question. And because like if you're owning a stock, all you really have to do is hold it. And then the management is there, like they're making money for you, they're making the right decisions. You just essentially have to sit there.
Yeah.
But what we do is we look for new ideas that could fit into the Baskin portfolio. But because the names that we already own are really good businesses, usually after we look at a name, we look at it and it might be a good business, but it's not better than what we already own. And then we put it on the list and then we move on to something else.
Yeah. But we've done the research, so we have it in our back pocket. I probably preempted what you're going to say.
Yes,
but
exactly. Yeah. And so MSCI is an example of a company We've looked at it many times over the years. Have kind of kept up to date with what's going on with the business. Valuation has always been a little too expensive for my comfort level, and we didn't think it was more attractive than what we owned in the portfolio. And so we just never bought it. But even though we recognized that it was a great business.
Starting point does matter. So when we bought Costco, for example, I think we started buying around the $300 US range. And we paid a lower valuation than it is today. It's grown healthily into its valuation. When we're buying a brand new idea and committing a lot of capital at the beginning to this idea, we don't want to overpay for all clients right at the outset just because it's a great business. And MSCI is an example where you could have overpaid, I think, in 2021 for the stock. It was trading well above $600 a share, probably 50 times earnings. And that valuation may make sense, but we weren't prepared to swap what we thought was a good business in our portfolio at the time for MSCI at that valuation level.
And so basically what happened was that MSCI had a rough quarter. They're impacted by a bit of short-term things that are going on in the industry. And we thought the valuation was attractive for a great business. And that's why we pulled the trigger.
So what does MSCI do?
So MSCI stands for Morgan Stanley Capital International. As the name suggests, it came from Morgan Stanley. There was a guy called Henry Fernandez, who is still the CEO today. He was at Morgan Stanley. He was building out this business to create tools for the investment industry. In 2006, Morgan Stanley decided that they didn't want to be part of this business anymore.
Dumb move.
And they spun it out as an independent company.
For those who don't know what Morgan Stanley is, it's an investment banking business, wealth management, more of a transactional type business. That's somewhat similar to what we do now, managing money, but mostly transactions. And this type of business didn't really fit in as a business selling licenses for technology, for data, for indices, they spun it off.
And so MSCI's main business today is what they call the index business. And what indexes are is basically a list of stocks that you use to benchmark your performance against. So like the S&P 500 is probably the most famous index that's out there.
And that's owned by S&P Global, a publicly traded company, and MSCI owns the MSCI indices.
Yes.
Hence the name.
Yeah. So MSCI's, I think what they're most well known for is their MSCI All World Index. And the way that this works is if we wanted to start a new fund and we wanted to benchmark ourselves to the MSCI All World Index, we basically call MSCI. We say, we want to show our performance against your index.
Yeah.
And I'll say, okay, here's please pay us like $10,000 or whatever.
Yeah.
And then you can use it.
Yeah. And you sign a contract for some length of time, and to renew that contract, probably the price goes up every year or every few years.
Yep.
It's a software business.
And it's a great business because, number one, because MSCI has the brand. And this is important because you want to benchmark yourself to something that people know.
Yeah.
If we were launching a fund and we benchmark to Ernest's international index, no one knows what that is.
And this so the indices matter. They matter less to possibly our clients, like my parents, who are clients, don't care that we benchmark to MSCI or S&P 500 or whatever. But if you're trying to sell your product to a institutional investing company, a large endowment, a sovereign wealth fund, you need to have a recognized benchmark.
Yes.
And so and generally the MSCI is global, right? So we're all North American centric here, but there's a lot of funds and investments, Europe and Asia and what have you, and they use MSCI as the benchmark.
Yeah. So just to make an example, to make an example of this. So suppose you were like Canada Pension Plan.
Yeah.
Suppose that they wanted to find a mandate for somebody to manage their international emerging markets portfolio.
Okay.
So what they would do is they'll go out and they'll talk to all these different managers that know how to manage money in emerging markets. And then what they will do is they'll say, okay, you have to benchmark yourself to the MSCI Emerging Markets Index, whatever it's called. And if you want to win the mandate to manage CPP's emerging markets mandate, you have to pay MSCI or you're not going to win the mandate.
No, you're not going to win the mandate. But so can a pension plan, when it invests in emerging markets, that's the benchmark.
Yes.
Why else would they choose you unless they can match all their investments they've made in emerging markets with manager A, B, C, and D? How else can you benchmark unless it's a uniform benchmark? And they're not going to choose some made up baloney benchmark that the manager picks. It's a standardized benchmark. And so MSCI is a winner there.
And so MSCI is kind of the standard. It's the company that you would choose if you were going into international markets, whereas the S&P 500 and maybe the Russell indexes are the ones that you would use in the US.
Totally.
And over time, they've benefited as investing has become more globalized. More and more people are creating portfolios that are adding stocks from Europe or Asia. And MSCI has been benefiting from this as well.
And Ernest, does it benefit from this trend of going exchange traded funds every time BlackRock or whomever launches a targeted niche fund?
Yes.
Yeah.
Yeah. So MSCI is most known for, as we talked about, the MSCI All World Index, but they actually have 290,000 indexes.
That's a lot.
And the reason why they have so many is because you just have to think about it. There's an index for every country, every possible formulation of countries. Like there would be one for Europe, there would be one for Eastern Europe, one for Western Europe, one for Poland, one for UK, one for France.
Yeah.
And then within all of these countries, there would be an index for like large caps,
small
all caps, mid caps, small caps,
dividends, no dividends.
Yes.
Yeah, it's crazy.
Adjusted for like
currency,
and then
hedging. Yep. So it just they have 290,000 indices that they license that you must pay a fee if you want to use it in your marketing materials, on your website, in your brochure. You know, as an example, we were thinking of comparing ourselves to a certain index in a brochure. We don't send out a lot of physical brochures every year, but we were thinking of it. We got an estimate, and I'm like, that's not worth it. I'm not paying $150 a brochure to license an index. It didn't make any sense to us, so we don't compare ourselves to any benchmark.
But but the reason why MSCI is such a great business is because if you really think about it, it's just a list of stocks, right? It's not like they're going out and making semiconductors or something like that. It's just a list of stocks that they have to make. And
well, there's some work to there's criteria that has to go into the stocks, and if they put stupid stuff in there, it's going to lose credibility. So we can't just say it's there's no effort put into it. Yeah, but,
not that there's no effort, but if you pay for the license, all they really do is they'll send you like a line of code and say, okay, here you go. You can integrate it into your Bloomberg. Yeah. And there you go. Yeah. Right. There's no additional cost for them to provide the service.
And so one very interesting thing is what happens if you're running a fund and you want to switch the benchmark from MSCI to S&P 500?
Well, that's a very arduous process. Yeah. You have to your board has to approve the changes. You have to get approval from all the unit holders.
What a pain in the tuchus.
You're just not going to do it.
Yeah. You'd rather just close down your fund or start a new fund. You would start a new fund.
Yes.
Over changing the benchmark.
And so I think if you boil all this down, MSCI's index business has 70% margins, which is probably the highest that I've seen like anywhere. Yeah. Like if you compare to Google, for example, which some people say is the perfect business model, Google is like 40, 50%, right? And MSCI is here at 70% margins. Like there's just nothing like it out there in the public.
There's next to no cost if you and I were starting a fund to license out another index and to pay MSCI.
Yes.
So why, Ernest, did the stock fall recently? What was the reason for the pullback, and what got us interested?
Yep. So I think some of it was simply the slowdown in the asset management industry. MSCI's largest customer base is asset managers and financial institutions. And because of what's been going on in the markets over the last little while, there's been some consolidation going on. Yeah. So,
and has there been fewer launches of new funds?
Yes. Yeah. And so, if there's consolidation, then two customers become one,
You got it.
and that's not great.
So there's a big merger in Europe, and so MSCI, as we talked about, a lot of global indices. So UBS and Credit Suisse,
Yep.
two European banks, wealth management companies merged, and so those two big customers became one.
Yes.
And so that, I think that was well known, but no one really understood what the impact was going to be. As a result of that, I think MSCI stock fell about 20% on the day it released its earnings. And yeah,
And there was another issue with one of the things that has been a growing portion of their business is their ESG business, what they call. And basically what this is it's the same thing as their index business, except with ESG factors. So if you go on
ESG is, for those that don't know,
environmental, social, and governance factors.
so it's a way to benchmark or rate mutual funds or investments as to whether they take those issues into account. And if you're an investor, institutional investor, that's important factors for you, then your fund needs to be rated on those factors, correct? As well as well as the investments inside your fund.
That's right. So if you go onto the website of any mutual fund, for example, and there's usually a section called the ESG section.
Yeah.
And there's like a rating, like, oh, the average stock in this fund has a ESG rating, right? So that's another fee that goes to MSCI.
So you're paying an independent third party, which is MSCI, to provide ratings on your fund.
And this was a big deal, I would say, from 2020 to 2021. ESG fund, everyone was launching ESG funds. I think the SEAM stuff slowed down a little bit. And there's a little bit of political, I guess, backlash in the US about whether ESG is, what it represents and all those kinds of things.
Getting off topic with the ESG, I think one of the things that ESG was really against oil and gas. And of course, when oil and gas prices skyrocketed in 2021 and 2022, a lot of funds who didn't own it underperformed dramatically, us included. And people were like, well, ESG is costing me money in the short term. Maybe it will make you money in the long term. So the story is not fully written about ESG and its benefits yet, but this is the impact that it had in the short term and why maybe fewer demand in the short term.
But anyways, MSCI had been expecting like very high growth for their ESG business, still growing, but at a slower pace than it has been. So I think those two things put together are the reason why the stock had fallen to a more reasonable valuation.
Yeah. And that reasonable valuation for us. So to break it down to clients and to those listening, what are we trying to achieve when we're buying a company? We're trying to buy a company that we hopefully will deliver double-digit plus returns to our clients over a multi-year period and outperform an index, right? Like an S&P 500. What else is why be active managers if you can't outperform, or at least try to outperform, right? So we're choosing to buy a healthy allocation to a stock that we hope will deliver strong results. Had you bought MSCI since 2006 when it was spun off, I think you would have made like 35 times your money. So it's been a successful investment. The stock has done well over the last 5 years, but cooled off over the last 3 years. But we still, Ernest, think there's a strong runway of growth. Obviously, from 2006 to now, the company's much more established, much larger, so maybe not as great result. I don't think we're going to make 35 times our money over the next 15 years on MSCI, but I think we'll do okay.
I would say so.
Yeah. So anything we didn't talk about Henry Fernandez or capital allocation. So we talked about the great business, reasonable valuation, capital allocation is the final factor that we're looking for when we're owning a good business. What does MSCI have in terms of capital allocation and management that makes it so attractive?
So one element that is really useful about great capital allocators or companies that allocate capital well is they'll often tell you when the stock is cheap by buying back stock. There's some companies that they just kind of buy back stock whenever at whatever price. Some companies do a terrible job of doing buybacks and
using debt, for example,
at highs, and then they don't buy back when it's low.
Yeah.
Companies like MSCI, they do a great job of recognizing when their shares are attractively valued and buying back stock. And they are buying back stock today.
Yeah.
So
we also saw, Ernest, a large insider buy from Henry Fernandez and a couple other of the C-suite executives buying stock. Henry Fernandez, is he a billionaire or close to it?
it should be.
Should be. And so, billionaires don't tend to spend millions of dollars on stocks. They should be selling, right? They should be going to a beach and reading a book. So we like those type of companies. Henry Fernandez, the allocator, the CEO, the chairman, whatever, who's sticking around, very wealthy, and wants to continue to grow the business. We love that kind of asymmetric upside.
Apparently, he's read Outsiders twice.
Oh, really? Maybe he can read it a third time. But I think the goals are there, right? MSCI is going forward. I assume we'll be launching more products and services to sell to financial services. One could imagine, more things to do with climate change, possibly
Private assets.
private credit, private equity. There's a lot more things to be rated, and as the world grows more to these private investments, right, the gigantic investments of these alternative asset managers, how do you benchmark them? And so I think MSCI is going to have a significant potential from that as well. Did we cover everything about MSCI?
Hopefully.
Beautiful. So that's all we have for you this week, and we'll see you back here real soon. Take care.